What's up, guys? Welcome to the Cash Craft, your daily dose of finance and technology news and updates. Grant Cardone just announced he's turning $5 billion of real estate into tokens you can buy on a blockchain. This isn't some startup trying to disrupt the industry. This is a real estate heavyweight with a massive existing portfolio, making a bet that the future of property ownership doesn't look like signing papers in a lawyer's office. And whether you care about crypto or not, what's happening here reveals something bigger about where all of this is actually going. Because here's the thing, tokenization has been the promise that never quite arrives. For years, we've heard that real estate would move on-chain, that ownership would be fractionalized, that regular people would be able to own a piece of a Manhattan office building the same way they buy a stock. But it's mostly stayed theoretical, small pilots, experimental projects. Nothing that made you think the industry was actually changing. Until now, apparently, Grant Cardone's firm manages a $5 billion real estate portfolio. That's not a thought experiment. That's actual buildings, actual tenants, actual cash flow. And he just announced on X that he's preparing to tokenize all of it. Let's be clear about what tokenization actually means here. It's taking ownership of real estate and representing it as digital tokens on a blockchain. Instead of owning shares in a traditional real estate fund where you're locked in, paperwork takes weeks, and minimum investments are high, you'd own tokens that represent fractional ownership. Those tokens could theoretically be traded, transferred, or sold with the speed and efficiency of crypto transactions. The appeal is obvious. Real estate has always been the ultimate illiquid asset. You can't sell half your house when you need cash. You can't buy $10 worth of a commercial property in Miami. Tokenization promises to change that. It promises liquidity where there was none, access where there were barriers, speed where there was friction. But here's where it gets interesting. Cardone isn't the first big name to talk about this. He's not even the first to try it. What makes this announcement different is timing and scale. We're in 2026 now. The regulatory environment around digital assets has matured significantly. The technology has proven itself. And critically, there's now infrastructure that didn't exist 3 years ago. Custodians, exchanges, legal frameworks that make this possible without stepping into a regulatory minefield. Cardone is also entering at a moment when traditional real estate is facing real pressure. Interest rates have shifted the entire calculation for property investments. Institutional money is looking for new structures that offer better terms than the old models. And there's a generation of investors who are completely comfortable with digital ownership, but have been priced out of real estate entirely. Now, pay attention to this next part. What Cardone is really testing here isn't whether blockchain works. We know it works. What he's testing is whether there's actual demand for tokenized real estate at scale. Because you can build the most elegant technical solution in the world. But if investors don't want it, or if the friction of buying and holding tokens outweighs the benefits, the whole thing collapses. And that's the open question. Will traditional real estate investors, the people who currently put money into Cardone's funds, actually want their ownership represented as tokens? Will they trust the custody solutions? Will they accept the tax complexity that comes with digital assets? Or is the real market younger, crypto-native investors who've been waiting for exactly this kind of bridge between traditional assets and blockchain? What most people miss is that tokenization isn't just a technical upgrade, it's a complete reimagining of what ownership means. When you tokenize a $5 billion portfolio, you're not just making it easier to buy and sell, you're potentially unbundling everything. Voting rights could be separate from cash flow rights. Geographic exposure could be isolated and traded independently. You could own the appreciation potential of a building without the rental income, or vice versa. That level of flexibility has never existed in real estate. And it creates opportunities, sure, but it also creates complexity that most investors have never had to think about. Cardone is essentially saying, we're ready to find out if the market wants this level of control, or if the simplicity of traditional ownership was actually a feature, not a bug. The bigger picture here is that when someone with a $5 billion portfolio makes this move, it forces the entire industry to pay attention. If this works, if Cardone can tokenize successfully, attract capital, and prove the model, every other real estate firm is going to feel pressure to follow. And if it doesn't work, it's going to set tokenization back years, because the narrative will be, if Cardone couldn't make it work at scale, who can? The question you should be asking yourself is not whether blockchain can handle real estate. It's whether real estate investors are ready to handle blockchain, because the technology is there. The regulatory path exists. What we're about to find out is whether the demand is real, or whether tokenization has been a solution in search of a problem all along. Personally, I'm watching this closely because if it works, it changes the calculation for anyone who's been sitting on the sidelines of real estate thinking they're priced out. For me, this is the first time tokenization feels less like a pitch and more like something that might actually reshape access to an entire asset class. That's all for today, folks. If you found this helpful, make sure to like and subscribe to the Cashcraft for more finance and tech news. Drop a comment below with your thoughts, and I will see you in the next one.